So now we're going to talk about art and collectibles. This comes up a lot in our practice, and there's a lot of confusion around the applicability of these kinds of assets for charitable giving. So I hope in the next 8 to 10 minutes we'll be able to demystify this a bit. I'm going to tell you a story, and it's a painful story because it was a lesson learned, a teachable moment on me, which I'm not very happy to record here. But I had a donor about 12 years ago, and he had 2 pieces of modern art. And I didn't like the modern art. He didn't like the modern art either. So we'll start there. But he had inherited that art from his grandmother. His cost basis in both pieces combined about $100,000. And he didn't like it, so he didn't have it in his residence. It was actually in storage and insured. And he called me and he said, look, I'm considering giving this modern art to my synagogue. And he said, would that be a good idea? And I mistakenly said, I don't think it's a very good idea to do that. Because here are the rules. The rules are if you give any tangible personal property to a charity that is not able to put it to a related use, paintings, the museum they hang, that's a related use, related to their exempt purpose. If you are not able to do that, paintings to his synagogue that they sell, that will be a deduction that is the lesser of the tax basis or the fair market value. So to me, growing up as a planner in this field, I always thought the cost basis bad. That's not good. Fair market value is good. So he will not get a fair market value deduction, therefore may not be a very good gift. And I asked him, I said, well, what did you intend to do? And he said, I intended to leave this in my will to the synagogue. But there are a number of things that they are doing right now that I would like to be able to support. And in fact, there are a couple other charities I would like to be able to support as well. I don't have a lot of cash. I really don't like the art, and I don't want to keep it anyway. And Sotheby's has been after me for the last year and a half to sell, consign, and sell this art because this artist is hot. And I said, well, I kind of wish it would have been a better gift. And he said, and I'll never forget this, he said, help me better understand something. And nothing good ever comes after that comma, by the way. He said, if I leave it to my synagogue in my will, I get a charitable estate tax deduction, right? Well, yes. He said, but if I give it away now, let's say to a donor-advised fund, I can make that gift and it's already out of my estate for estate tax purposes, right? So it's the same benefit. Well, yes. And I can sell that art without any capital gains taxes because the charity in this case would own it and would be selling it, right? Well, yes. And when it's sold, obviously I'm not going to have to pay for insurance and storage for the next 25 years, which is how long he had hoped to live. He goes, so all that negative cash flow goes away, right? Well, yes, and I can pre-fund all of my future charitable giving, at least in retirement, by making gifts to the synagogue at a much larger amount that I would be able to make if I were going to only rely on cash or, frankly, other marketable securities. Well, yes. He said, why wouldn't I want to do that? That was a good teachable moment for me. He should. It was perfect. He was able to use an asset that he really didn't want to have anyway, downshift his material lifestyle stuff, didn't have it in storage and insurance, using that to sell into a hot market and to use the proceeds then through the donor advised fund to support his synagogue and to support multiple other charities too. So that's how that case study worked. I hope that when you're working with clients and working with your donors, that you pause. And even if something isn't super tax-wise, even though this was still pretty good, it can still work very well to achieve their objectives. So don't have the knee-jerk response that I did, so I'm guilty too, and not really listening to what it is that the donor wishes to do and then aligning back what assets might be the most appropriate ones to fulfill that specific objective. So we've already covered here sort of the step 1 around donor contributes the art and collectibles. For a donor advised fund, it did not meet the related use rules. But could this donor have also given this as a gift to a school that they would then display that art, or a museum? Yes. And he would have received a fair market value deduction. That'd be great if that's what the donor wished to do. But also think, he said, when all the dust settles, he had $650,000 in his donor advised fund that he could use to fund all of the giving. So he only got the deduction on the $100,000, that was his cost basis, but he had a fund when all the dust cleared at $650,000. Instead, he could have, and it would have been completely fine, to give that painting to the museum, gotten a $650,000 deduction, but then no fund at the end to be able to make other charitable gifts. Neither one's right or wrong, but I want you to think about and consider those two paths of being able to give art and collectibles. All other collectibles follow the same regime. So a collectible, art, are tangible personal property. If you can touch it and move it, it's tangible personal property. Coins, jewelry, antiques, all of those kinds of things fall under the same realm. So the donor in this case gave the two pieces of art. They were sold at Sotheby's. All the dust again settled, and he got the deduction for the $100,000 and $650,000 in his donor advised fund, and was happy as could be about being able to do that particular gift. So now we're going to talk about charitable planning considerations with art and collectibles. Opportunities. So I've really covered this, but I want to make this very, very clear. Even if the donor does not receive a fair market value deduction, the capital gains tax rate federal is still 28%. It was never lowered to 15. It was never increased to 20. It has been 28% as a collectible. So we've dealt with gifts of wine. We've dealt with gifts of all kinds of jewelry. Most donors don't realize that if they were to sell those collectibles, that the 28% collectibles tax for gain would apply. Also, no state income tax, so that goes away, and possibly the 3.8% net investment income surtax also would be avoided. This assumes that the donor is not making this gift directly to a museum to get the fair market value deduction anyway. So this is really the opportunity as a fallback for a donor wanting to contribute to a charity that would not be putting it to a related use, but still wishes to do that for all of these sort of tax benefits. But more than that, goes to this bullet point number 2, many donors wish to make these kinds of gifts for lifestyle reduction. The heirs may not want the property, donors may not want to store, insure, manage the assets. We worked with an amazing family that had a very, very vast art collection. And when they saw the Haitian earthquake and the damage that it did there, they'd done some work in Haiti prior, they met as a family and they said, this is art that has wonderful value in the marketplace but doesn't have the same value to us. And more importantly, we would love to be able to unlock the value of that art and redirect it to help those people that we see are in such need. We ended up working with them to sell about 26, 27 pieces of art, multi-million-dollar collection. They got a cost basis deduction on every single one and were as happy as could be about being able to populate their fund and make those grants to help those people that they saw needed help the most at that point in time. Very, very important point. It included Picasso and Matisse and de Chirica, a number of different kinds of artists. But for them, as a family, these were pieces that were surplus or were not as valued perhaps as they were by their parents or grandparents, and they all agreed that those would be the best assets to make as gifts for that specific situation. And finally, let's talk about a few of the traps. We've really covered this already a bit. Fair market value deduction if charity uses property for the related exempt purpose. And my point here is the charity now must certify that they will use it for the exempt purpose. So on Form 8283, there's actually someone within the charity has to sign that form saying, yes, they intend to put it to a related use subject to their exempt purpose. A qualified appraisal is still required, even if cost basis is the deduction. So a qualified appraiser must complete a qualified appraisal to complete Form 8283. This trips up a lot of people because they would say, well, I know it's worth $1 million, let's say, but now I see that it's only, $100,000 might be the cost basis. Why do I need to go and get an appraisal? And the point is, technically the rule is that the deduction is the lesser of the two. So you have to have an appraisal first as the qualified appraisal to then have the value so that you can plug that number in as the fair market value, and then the cost basis is then included on Form 8283 as well, and you have to use the smaller number. So you can't just go by the sales price, you can't go by anything else other than a qualified appraiser completing a qualified appraisal. And the final point here is for art gifts over $50,000, there is a process. This is just for art gifts, interestingly, where there is an IRS art advisory panel. So if any of these ever were to come under audit, there is actually an advisory panel that would review that appraisal, in particular if you're taking a fair market value deduction for a gift to a charity for a related use. So just some things to keep in mind. Very complex area as well. So art in some ways are handled a bit differently than other collectibles. Coins, believe it or not, are the most complicated kind of gift almost that there is. Think about even the value of the coin. Is it the denominational value, the number that's on the coin? Is it the intrinsic metallic value, the metal in the coin? Is it the numismatic value, the antiquity value of the coin? I mean, your head will start to explode. So you're going to be very careful about these kinds of gifts where coins perhaps are valued differently, and certainly the deduction might be basis as well for coins unless it's going to a coin museum. These are things that we're glossing over a bit going through this 8 to 10 minutes, but just want you to know, A, they are very possible to be able to make these as charitable gifts, but B, just be careful, thinking about some of these traps and then digging a bit deeper into the specific kind of collectible to see if there are other planning considerations that warrant your attention.